Thank you everybody for tuning in to this latest episode of Coffee with Bob. This is a pop-up episode, which means it's not live and we're not going to be taking questions at the end of this episode today. But if you do have any questions or would like to discuss anything that we talk about today, please do call us 412-261-5966. And we're really excited to bring this topic to you today, why we are beating our benchmark. It's something that we strive to do quarter over quarter, year over year. And we're going to talk about why we're doing so well this year, beating our benchmarks by a little over 2% year to date. And, discuss really the value of having a dedicated investment team behind that investment game plan for your goals. So with me today, the investment committee here at H&A is back, a couple members of the investment committee at least. I have Bernard Carter. Bernie is a CFA and a CFP, and he is our managing director of investments here at H&A. And Bobby Hapanowicz, wealth advisor at H&A, also helps head up our investment committee. So thank you guys for being here today. First Coffee with Bob that we're doing all together here in the conference room. Happy to have you guys.
It's good to be here.
Great to be here.
All right, so let's dive into this topic. Actually, before we do so, a couple housekeeping items. We have a YouTube channel, so you can watch all past episodes of Coffee with Bob on that channel. Just search Hapanowicz Associates YouTube on Google, and you can find us very easily. Or any future Coffee with Bob episodes that are live. If you're not able to tune in live, we always upload those episodes after we broadcast them, and you can watch them at your leisure. All right, so now let's dive into this topic, why we are beating our benchmark. But before we do that, before we talk about these reasons, I want to first define what our benchmark is. So Bernie, can you please define what the benchmark is that we use here at H&A?
Sure. Thank you, Chris. Thanks to everyone for tuning in. So when we measure how your investments are doing here, we want to use a standard that's relevant. We want to use something that represents the clients that we have and the investments that we use. So we use a blended benchmark that's composed of stocks and bonds. On the stock side, it's a benchmark that uses that references U.S. stocks. About 2/3 of the stock benchmark is the S&P 500, which is a very broadly used benchmark of the U.S. stock market. And then we also use for the international side an index called the MSCI, Morgan Stanley Country Index, and it generally covers the stocks outside of the United States. And that's about 1/3 of the stock allocation that we that it covers. And then on the bond side, we use an index called the Bloomberg Barclays U.S. Aggregate Bond Index, which is by far the most popular index used for tracking the U.S. bond market. So we use those in a 60% stock, 40% bond mix because that's our typical client. And in fact, that's pretty much the typical investor in the marketplace. So we think it's a very relevant benchmark, and it very adequately tracks how we're performing against the market.
Okay. And so, what a lot of people do is tune into CNBC and they see the S&P and they're, saying, okay, well, what am I doing compared to the S&P? So it's really important to not just look at, the most popular benchmark in the industry, but a benchmark that encompasses what, everyone's portfolio is really made up of, wouldn't you say?
Absolutely.
Yeah.
Absolutely.
So, all right. Thank you for that, Bernie. Okay, so let's talk about the three main reasons that we are beating our benchmark. We've identified the three main reasons for you guys, and we're going to get into those in a little bit of detail today. So let's go to the first one, rebalance strategy. Bobby, talk to us about our rebalance strategy.
Right. Well, rebalancing, Chris, is probably the most important reason, the biggest contributor to outperformance this year. We've outperformed that benchmark by about 2% year to date. So rebalancing is one of the most important reasons for that. It's also the centerpiece of our investment strategy that we do here at H&A. And the reason for that is, one, most importantly, rebalancing is the process of getting your account allocations back to your long-term goals, where they're prescribed to be based off of your long-term goals. And it does so by buying low and selling high. And as investors, that's what we all strive to do is buy low and sell high. And if you could do that, if you're successful in doing that, then that will lead to some outperformance for you as well. And again, you achieve that outperformance, you achieve that that proper allocation for you in a way that takes the emotion out of investing, rather than forecasting or predicting what the markets are going to do. We let the markets tell us what we need to do in accounts.
Mm-hmm.
And there's a couple of different things that we use for that. We use valuations in the market, and most importantly, again, we use your account allocations to tell us when it's time to do so. So again, that's the process we've been taking the past 12 months. At the end of 2019, we were trimming from stocks when the S&P 500 was up 30% for the year. In March of this year, when the S&P was down and when stock markets were down, we were heavily buying, because again, that's what the account allocations told us was necessary to do. And since then, when we've had this historic rally, we've been modestly trimming from stocks as we have continued to rally. And because of that, we have accounts have been fully participating in that rally, while also, keeping the level of risk appropriate to the client's long-term goals.
Yeah. A lot of people think buy low, sell high. It's easy, but it's easier said than done. And there's a lot of discipline, a lot of wherewithal and intuition to continuously and consistently carry out a successful rebalance strategy, and apply that approach to the wealth and the money that we manage. So it's a really important aspect, and that's why we wanted to talk about it first. Okay, so let's turn it over to Bernie. Let's talk about the second reason we are beating our benchmark strategic income. Go ahead, Bern.
Sure, thank you. So a couple of things both of you said: buy low, sell high, and buy low, sell high, but easier said than done. I mean, those are two very important themes that we try to implement here at H&A. And another example of why we're outperforming our benchmark so far this year is because back in March, when stocks were falling because of the coronavirus panic, corporate bonds were also falling in price, in sympathy with stocks. People were beginning to question whether corporations could pay their bills. So corporate bonds were falling. Now, we saw that as an opportunity. Corporate bonds became much cheaper relative to government bonds, which are typically the overwhelming majority of the bonds that are in our client portfolios. Corporate bonds became cheaper. We viewed it as an opportunity, and we allocated to that area. Now, the term strategic income, we often use to describe strategies that incorporate more corporate bonds than government bonds, and that's why we call it that. And since we made that allocation in mid-spring, that part of the bond portfolio has dramatically outperformed its benchmark. And that has really helped our relative performance this year, and it's a big part of why we are outperforming our standard.
Fantastic. It's a good story. Okay, let's turn it back over to Bobby. Last but not least, let's talk about small caps. Bobby, round it out for us.
Sure. Well, on the stock side, so again, as we mentioned, we were heavily adding to stocks back in March. In particular, we were adding to small caps for a couple of reasons. Again, first and foremost, because account allocations told us to do that. Small caps were down more than any other stock and stock asset class, more so than most at least. Another reason why, so again, it was important to rebalance to get that up to the proper allocation. The second reason why we did that is historically we know that small caps tend to underperform in the later stages of business cycles, and they tend to outperform in the early stages of business cycles when business conditions are a little bit easier, and that's an environment that small caps can thrive in. And in March, the market was pricing in a recession already. So we looked at that as a very good time to add to small caps, not just back to our target allocation, but a couple of years ago, we took our small cap allocation from here to here. And in March, we were down to here. So rather than just adding back to here, we said, okay, let's take it back to our historic allocations that we've been to. And that has proved to be very additive as well. It's hard, you'd be hard pressed to find an asset class on the stock side that has outperformed small caps since March. So that has
absolutely.
been
Thank you, Bobby. Thank you both. this is by no means a guarantee of what's to happen in the future, but this is such a fantastic success story of, again, what it means to have a disciplined and dedicated investment team behind your wealth. So we wanted to share it with you. You know, first and foremost, we are financial planning approach first kind of firm. We believe that the most important benchmark is actually you and the goals, the intermittent and long-term goals that you have set within your financial plan. But nevertheless, pure investments benchmark is still very important to review from time to time to see how your investments are doing relative to the markets. Thank you both so much for joining me today. This was a great pop-up episode. And if you guys, again, have any questions, please do reach out to us. We'd love to be that resource to you and talk through any of this with you in more detail. And we'll see you next time. Thanks, everybody.
Thank you.